Hey guys, welcome back. In today's video, we are talking about how institutions only want to long AMC, how the massive shorts can't cover, the AMC efficiency, and many more in this video. First, we take a look at this. The level of AMC gaslighting is beyond belief. Institutions are adding more and more AMC long shares while trying to convince retail there is no hope for AMC. You can't make this stuff up. So if you take a look at all the news articles that you're seeing right now, it's essentially people who are trying to make you sell your AMC shares and or to convince you to stay away from AMC. And you can see how they're constantly releasing these articles. It's one of the biggest things we've shown in terms of how we say that one of the strategies these institutions use are media narratives. You can even see here, is there any hope for this former meme stock down 35% in 2025? However, what they fail to say is how institutions, whilst despite reading these articles, they are accumulating AMC. Institutions now own 235 million AMC shares long, worth, and biotech has already corrected this mistake, $695 million. So institutions have added 42 million more long AMC shares in the last 3 months, but this is what they pay and place in financial news for retailers to read. Once again, the articles that are constantly degrading AMC, that are constantly telling you to stay away from AMC and sell AMC, but yet the money, the capital are doing the exact opposite. And you can see here in terms of the institutional value on AMC as well. And so this is something that we have always talked about with how they are giving you a false narrative, how the institutions do not have the retail's benefits in mind when they do this. They do not have your best interest, because how can media articles release all of these things? How can media articles be so certain on selling AMC where institutions are doing nothing but buying? And more importantly, the institutions who were previously short have all bought into AMC as well. And from there, you can already understand just how ridiculous that is. And if you want some examples of certain firms, you can see here, wow, look who just added 1.66 million AMC shares. Jump Financial, a Chicago pod shop that uses high frequency trading and quantitative AI/algos. This is significant as Jump uses AI math models and quantitative algos to determine buys, and their models flagged AMC as a long-only unhedged buy. And so this is something that should be extremely significant already. Yes, we have the high frequency that are constantly spoofing AMC. However, they're not doing it because they view AMC as a bad stock, but rather they're doing it because they can't afford AMC's price to go up. And so that's an extremely biased view. But when you take a look at what the unbiased algorithms are showing, is that AMC is a long only without any hedging involved. And so this is why we've said that institutions view the opportunity, they realize the potential, the projection there is for AMC. And so for people who are saying that, AMC is a sell, that AMC has no potential, well, the institutions are clearly showing a different thing. And the big thing why I like about this is the fact that it's an unhedged buy, which shows the certainty they have on AMC. But not only that, you can even see here in terms of the institutional filings on AMC and how these guys have increased their shares. We can see here how much they've been buying. We're seeing companies like Barclays, BlackRock, and many, many more as well. Recently, we talked about Citadel as well. But so this isn't just one institutions who are buying AMC, but rather multiple different institutions who are all trying to accumulate as much AMC as possible. And so when we're seeing the AMC price go down, which this is not something I'm going to lie about because you can clearly see it, it is giving a completely different reaction to what the media is saying. The media is saying that AMC is going down is because of people selling, it's because no one is buying, and therefore you should not buy. However, the institutions, the big capital, as they see AMC drop, they are trying to buy up as much as they can. And so we can already understand from here just how much potential there is one of the biggest reasons for why I say that people don't realize truly the value of AMC if they're just looking at media articles as opposed to what the institutions are doing. Now, another thing, which is UBS, you can see here the recent UBS acquisition of 23 million AMC shares at $3 appears to confirm two things. UBS did inherit a massive short position from Credit Suisse, likely much larger than reflected in public short interest. 2, shorts don't expect to cover below $3 regardless of potential future dilution of AMC. And so one big thing, firstly, is that not only are we seeing institutions accumulate AMC, but you can see just how much they are accumulating. UBS here with 23 million shares, a percentage change of over 4,500%. So these firms aren't just buying small amounts of AMC, they're buying extremely large amounts of AMC. And so this isn't just saying that, some institutions are buying and because they got a big name, we should believe them. But it's about the fact how much capital they're deploying in this. Now, what's interesting about this, and another point that is not mentioned here, is I want to add on, which is understanding the position that UBS is in right now. We've seen how UBS are not doing well financially. We've seen what the regulations have been trying to make UBS do. We realize that they are having the need to increase their margin requirements. They're having to watch out on their overexposure. And so a firm, institutions that's right now in a really shaky place and have to carefully deploy their capital and make sure they can make the most of it, have just increased the share size of AMC by this much to show you the confidence that they have. But then going into what we talked about here, which is also another big reason, is the fact that very likely they did inherit the massive short position. This is something we've always talked about with the toxic swaps. It's one of the biggest reasons for why UBS is in the current position that they are in right now, because of how much this position is toxic to them, because how much it's making them lose. And so therefore, for them to not lose out as much on these swaps, they have to buy as much AMC as possible. And what better than buying AMC at its current cheap price so that they are able to buy more and more. And then secondly, is we can understand and expect that these shorts can't cover. So the massive short positions that people are worried about these short sellers covering clearly isn't the case, because despite how many shares they buy, they still can't cover these short positions. And so once again, going back to this dilution of AMC, as we talk about the issuance and authorization of shares, people are obviously worried about the fact that AMC authorizing 500 million and have ability to issue up to 500 million shares is going to bail out these shorts. But what we've seen from here is that the amount of synthetics that exist within the system that is in circulation can't be covered. It can't disappear just because of an addition 500, 550, or however many million shares that people are worried about. And so this is what we have to realize. Another big thing, and this isn't to start any controversy, this isn't to make an argument, but something that's very interesting is that right now UBS cuts stake in GME by 15% or by 50%, and many believes that Swiss banking institutions holding Credit Suisse legacy GameStop back. So one thing that I find very interesting, I'm curious to hear what everyone thinks about this, is that recently it's been quite an interesting turn of events. So for GME, what we've seen is UBS cutting their stake by 50%. And on the other hand, we just talked about this, UBS just increased their stake in AMC by 4,000%. Another thing is how Citadel has cut their stake in GME, but on the other hand, Citadel has increased their stake in AMC. So clearly something is going on here. Now, the reason why I say this, once again, it isn't start an argument, because I've always said this, we are in this together. There are mutual short sellers of both AMC and GME, and we've always said, whichever one squeezes first, the other will follow along with it. But it's extremely interesting to view this happening. And now, one of the things we've talked about is how it is easier to create synthetics of AMC than it is to create synthetics of GME, purely because of the price disparity of the two. Because AMC is sitting at $2, whereas GME is sitting at 20. And so it's clearly cheaper. And so with this understanding and the fact we're sitting and cutting their stake, firstly, what we can see is that potentially they need more shares of AMC to make sure they can even hedge slightly for AMC, because there are just plenty of AMC shares. There are just more AMC synthetics that exist in the system. But secondly, it could be potentially that right now with everything that's going on with AMC, like we've said, AMC is in an extremely good situation right now, is that these shorts are obviously worried for what's about to happen. You can even see here from Aaron, AMC already uses AI to become more efficient. We also will deploy AI to dazzle our guests. In that pursuit, we made a multi-million-dollar investment in Nova Sky Stories. Nova stages massive, mind-blowing, and beautiful aero drone light shows, thousands of drones powered by AI. Now, the reason why I'm mentioning this is not just because of this investment, but because of what this means for the future. One of the things we've seen Adam Aaron talk about is they want to increase their use of AI, not just for these drones that we see they've made investments in, but rather in terms of the actual movie theaters. And one of this data that we've seen in the past was the fact that foreign languages films have been doing extremely well. And so we talked about how AI can complement that and improve that even more. And so you can see how AMC is deploying their capital very smartly on things that will brighten and improve the current business structure. And so this is why we say that people realize the opportunity there is for AMC because of how well the company is growing. Now, another big thing is, just in, reverse repo has collapsed down to $1.5 billion. That's minus 100.33% compared to last week's average of 13.8 billion. Now, financial institutions' RRP usage in 2022 was as high as 2.55 trillion. So it's no wonder that stocks and cryptos are falling. This signals a massive drop in excess liquidity, which equals to margin call potential and volatility coming. So one of the things we've been keeping a close eye on has, of course, been the reverse repo. And so as we see it drop down to $1.5 billion, this is very, very significant in terms of what it means. Liquidity is becoming more and more scarce. The institutions who need a bailout will no longer have this access. And when we see this goes to zero, when we can't see any increase in reverse repo, and this is a big thing, which is not just reverse repo go to zero, which is important, but also the fact that they can't inject any more liquidity into the system for these institutions to borrow, that's when we will see mass covering. Because if they don't have the access to these easy liquidity, they will have no choice but to cover their positions to free up the capital. And once again, is why we talked about how AMC is applying that pressure and why we're seeing institutions trying to buy up as much AMC as possible. Another thing, the Fed buying a biblical amount of MBS every time banks got into trouble is the real reason why US house prices became unaffordable. Banks know they can lend recklessly and they will be granted a bailout no matter what, privatizing profits and socializing losses at its best. And so people are saying that these banks are lending out money because they realize that it's a big opportunity. However, in my opinion, I think it's the complete opposite. They are lending money recklessly because they do see profit. However, the more important part is that they see no repercussion. They believe that even if these investments were to not turn out well, they will still be bailed out by the government. However, that shows one thing, which is the fact that these investments are extremely risky, but also, like we've seen back in 2008, there were banks that were bailed out, but more importantly, plenty of institutions fell along with it. And right now, we're not worried about the banks as much. Yes, they're lending out money to the institutions who are then shorting AMC. But ultimately, our enemies has been these singular individual institutions. And so if they can't get bailed out, if they go bankrupt and have to cover their positions, that's when we can see the squeeze, of course, happening. Another big thing, and it's like I said, I don't want to start an argument because yes, we talked about how firms like UBS and Citadel are cutting stake in AMC, GME, but there are still important things that are happening. So as we're seeing the SEC releasing data, what we can also see is for the GME warrant, which is 1 million GameStop warrants on the day of issuance and 544,000 more the next day. So they were failures to delivers for the GME warrants, not GME shares, but the GME warrant that was supposedly meant to obviously given 10-1 and that everyone has it. And so the fact that we are seeing FTDs for GME warrant should already show you what's happening within the market. And so if you want proof and in terms of data of synthetic shares, this is what we are looking at. How can there be FTDs for warrants that were already aligned a month ago? And we knew that this happened because of GameStop synthetic shares. Now, one interesting thing and one way to look at this is because we know that these warrants were supposed to be given 10-1. So every 10 shares of GME, you would get one warrant. So the very fact we are looking at 1 million GameStop warrants could showcase that there were 10 million synthetic GME shares, and is why we didn't see these warrants hitting the market. Now, once again, that's just my opinion. Like I said, this isn't a confirmation, but the very fact we are looking at FTDs should be something that is already alarming. And you can even see here, it means that market makers are selling warrants that don't exist, and they are able to buy them within the required time period. That creates synthetic shares, fake shares that exceed the total number of shares in existence, artificially diluting the stock and dropping prices. So if you want to know the seriousness of these shares, of these FTDs, this is what's happening. And if you want to understand why they exist, this is also the reason. And now another thing you can see, yes, we talked about Citadel cutting their stake in AMC, but it's also this. I find it very interesting that Citadel has a position in GMEU, which is a complete disaster. Might there be an authorized participant on the GME shorting machine? So as we're seeing Citadel cut a stake in GME, we're seeing them increasing their stake in these funds of GME. And so this is what we've said. It isn't that fact that they've got out of these short positions, but rather they're trying to figure out other ways for them to actually get out, to actually solve the amount of losses that they've put themselves in. And you can even see here, another thing that we're looking at, Wedbush and friends parking stink bids on AMC. What else is new? So if you want to look at this, what we are looking at with the AMC price dropping, like we've said, this isn't done by the investors, but artificially. As we're seeing spoofing happening, that's what's bringing the AMC price down. And so institutions are spoofing AMC and pushing the price down. And then on the other hand, trying to then buy as much as they can. So you can understand the reason for why they're doing this. And then a big thing that we're still keeping attention to, which is breaking, huge news for all retail investors. Genius Group is set to file a lawsuit for spoofing relating to naked shorting today or possibly tomorrow. And so we talked about this lawsuit, which is them coming after the naked short sellers. And like we've said, this is very important because this could set something for the industry. And so if we knew who are involved and we are looking at regulations to help us, then this could be something that's very, very major. As always, none of this is ever financial advice, so do take advice to consult. Make sure you do your own due diligence and research, and I'll catch you guys next time.